So once again, my name is Victor and welcome to this webinar. So firstly, I would like to say that do stay safe and keep sanitizing your hand. I mean, we are experiencing a very tough time during this coronavirus case. So we decided to do a webinar to share about how do you read financial statements, since all of you or most people will be staying at home right now. So let me share my screen right now. What are you going to learn today is, of course, you're going to learn how to read financial statement. So I'll be going through the 3 different financial statements in a financial report, okay? What are they and how to read them? So basically, they are your income statement, your balance sheet, and also your cash flow statement, okay? So I understand that if you are totally new to investing, right, when you look at the financial statement, right, it will definitely be very, very confusing for you, okay? And I would like to tell you that it is absolutely normal. So when I just started out investing, reading financial statement is very alien to me, okay? And it's very confusing. But what I want to tell you is that when you learn financial statement, it's just like how when you were young, right, you start learning ABC or you try to learn your mathematics. It's very hard initially. Your plus, your multiply, your division is very hard initially. But if you keep practicing it, right, you'll get easy over time. So after this session, right, you should have a clear understanding of what financial statement is. And also I'm going to do a bit of hands-on for this webinar. So make sure that you have your phone calculator ready because I want you to do some work during this webinar, okay? And if you have any questions about the financial statement, don't type it out right now first. Write it on a piece of paper. And once we go to the Q&A part, then you type it out. Because if you type it out too early, I may miss out your question. So I don't want to miss out any of your questions. So do remember to write it first. And when doing the Q&A and ask me the question, everything regarding financial statement. Okay. And the next thing we're going to talk about is the type of matrix or the ratios that we look at in each of the statements. So I'll go through the financial statement first. After I'll go through what kind of ratios that I usually look at when I do a quick 10 minutes screening. Okay. Then after that, the whole financial statement I'll run through using one case study to run it through so that you can understand how we actually apply to a company. So the company I'm going to use is this company called Alphabet, which is the owner of Google. Okay. So if you're ready, let's move on. Okay, so if you have gone through or been through medical checkup before, right? Usually when you go to the doctor, right, they put you into a series of medical procedure. So at the end of every medical procedure, right, after you get tested of all different things about your whole body, they'll usually give you a medical report. And the medical reports will tell you whether you are healthy or are you fit or is there any issue about you. So same goes for the annual report, which is also the financial reports. They are like the medical reports of the company. So the financial statements tell you whether the company is doing well or are they healthy. Okay. So why do we actually look at financial statement? That's the most important question. Okay. So I always believe that every successful company leaves a trail behind. Okay. So when it comes to investing, right, we want to look at the financial track record of the company. Because if a company for the past 10 years have been doing well, right, there's a high probability that it will continue to do well moving forward. Okay, that's not a confirmed case, but there's a high probability. But if the company in the past 10 years have not been doing well in terms of the financial, then the probability of them doing well in the next 10 years is very, very low. So that's the reason why we want to look at our financial statement, because it tells us the probability. Okay, and every time when you look at the financial statement, right, minimum we want to look at 5 years, but of course the best is 10 years. So do remember to look at 5 to 10 years. Okay, don't look at 1 year. 1 year does not tell you anything. Okay, but 5 to 10 years tells you about the track record. And when we look at the financial statement, we want to look for consistency and we also want to look for growth. So that's the few things that we want to look about. Okay, so let's move on to the first financial statement, which is the income statement. So this is how the income statement looks like. And this is the income statement of Alphabet, which is the parent company for Google. Okay. So let's move on. So I'm going to explain income statement on a very simple term so that you can understand. And after that, we'll go through the financial statement life. Okay, so to explain income statement in a very, very layman term, I want you to look at your own personal finance. For instance, right, every month, right, you receive a salary. Okay, so your salary is, let's say, $5,000. Okay, so this salary is equivalent to the revenue in the financial statement. But along the way, when you receive your salary, right, you have to you spend it on your entertainment, you're spending on your groceries, you're spending on other stuff that you want to spend on, and that's what we call your expenses. Okay, so your salary is 5,000, your expenses is 3,000. Whatever you left behind is what we call your saving. Okay, and in the financial statement term, right, your savings is actually your profits in the financial statement. So income statement, right, of a company is the exact same as your personal finance. Just that the company, right, they use in different terms to elaborate the same thing. So right now, let us look at the financial statement of Alphabet. Okay. So I want you to go back to just now what I just explained about your salary, your expenses, and also your saving. Okay, so if you look at the financial statement, right, the revenue is actually your salary. Okay, and over here, all your expenses, right, is your expenses. Okay, whatever you left behind after paying the tax, your net profit here is your saving. So you can see on your personal level, this is how you should look like. Okay, your salary, your expenses, and your savings. Okay, let us go through each one of all these figure. Okay, so if you look at the first one, okay, which is your revenue. Okay, so example, okay, what is revenue in business? So example, I'm an apple seller. I sell an apple. I sell the apple to a customer at $10. So in the income statement, right, the revenue will record as $10. So this is how you actually look at. Okay, so but do take note that when it comes to the revenue, right, sometimes it can be quite confusing because there's a lot of different terms for revenue. So for instance, there is what you call sales and also called turnover. Sales, turnover, and revenue is the exact same thing. Okay, accountant want to make simple thing difficult, they give you a lot of different terms, but actually it means the same thing. So don't be confused if you see all these different terms. Okay, just get used to the financial jargon. After some while, it's very, very easy. Okay. Okay, let's move on. Okay, so when I look for revenue, right? So revenue is every time when the company sells a product or provides a service, you record as revenue in the company. Okay, so every time when I look at the revenue, right, I want to look for consistency. Okay, so the thing that I want to look out for is I want to look for increasing revenue or stable revenue. Okay, so these are the two things that I want to look for every time I look into the financial statement. Okay, and this is what I want to avoid. Okay, I want to avoid decreasing revenue and also volatile revenue. Okay, so usually these companies, right, they are volatile, right? They are usually cyclical companies, which we want to avoid. Okay, because there's no consistency in such companies. Okay, so let us look at the revenue for Google. If you look at Alphabet, you can see that the revenue is actually increasing. Okay, from 110.9 billion to 136.9 billion to 161.9 billion. So this is exactly what I want to look at every time when I look into the financial statement, whether the revenue is consistently growing. So if you have run business before, you know that growing revenue, right, is not easy. Okay, for a business to continuously keep growing their revenue, sometimes it also proves that they are in a very favorable situation or they are in a very growth industry. Okay, so that is your revenue. Then the next thing we have is what we call cost of goods sold. Okay, so let me screen that. So the next thing we have is what we call cost of goods sold. Okay, so sometimes you keep hearing people saying this word called COGS. Okay, so that is very common. Every time when people say COGS, it's the cost of goods sold. So let's go back to the Apple case. So what is the cost of goods sold for Apple? Okay, so when I talk about the Apple, that's when you sell, that's the revenue. So the cost of goods sold for Apple is their raw material, the seed and the fertilizer. Okay, so the seed and the fertilizer to grow the apple, that's their raw material. That is their cost of goods sold. So if you look in terms of Alphabet or Google case, instead of using cost of goods sold, they use cost of revenue. It's the same thing, okay, which is over here, cost of revenue. So this is their cost of goods sold. So if you look at Google, right, their cost of goods sold is basically where if you go to certain website, right, you can see the Google ads over at the website. So these are websites that they paid for traffic acquisition. So that's their cost of revenue. Okay, so right now I want to run a few tests and see whether you knows about what is the cost of goods sold. Okay, so what is the cost of goods sold for F&B companies? Those food and beverage company, what's their cost of goods sold? So I want you to type in the chat box right now and tell me what's the cost of goods sold for the F&B company. Type in the chat box right now and let me take a look. Cups? No, cups are not the okay, yeah. Matthew get it right. The ingredients, or chicken get it right. It's the ingredients, the raw material, the meat, the sugar. That is all your cost of goods sold for the F&B industry. Very good. So most of you get it right. Okay. So let's try some more. How about service business? Companies that provide a service. So what is their cost of goods sold? Please type in the chat box right now and let me know. Service business, people that provide service, what is their cost of goods sold? Okay, do take note that rental for F&B, right, is their other expenses. It's not their cost of goods sold. Okay, so most of you get it right. Okay, so the service companies, right, their cost of goods sold is actually their manpower, their employee salary. So that is the cost of goods sold. Okay, how about airline business? Airline. What's their cost of goods sold? Type in the chat box and let me know what's the airline's cost of goods sold. Okay, so most of you get it right. So the fuel, or you call it the oil or the petrol, is the airline's cost of goods sold. So that's how you're going to look at. Okay, so your revenue minus your cost of goods sold will give you your gross profit. Okay, but in Google case, they didn't show the gross profit over here. Okay, in most annual report, they will show you the gross profit. In this case, they didn't show you. Okay, so you can see that the revenue of Google is 161.9 billion, and the cost of goods sold is 71.9 billion. So right now, I want you to take up your calculator and calculate what's the gross profit for Google. Okay, take out a calculator and calculate now and type it in the chat box and let me know the answer. Yeah, just type it in the chat box. Okay, thank you, Wilfred. So the answer is actually 90 billion. Okay, so that is the gross profit for Google. Okay. Let me clear up all this. Okay, So let's move on. So now we're going to look at the different expenses segment, which is over here, the different expenses in Google, excluding the cost of revenue, which I already explained to you. Okay, so if you look at Google, right, they have this thing called the R&D or research and development. Okay, so this R&D, right, is not very common in most companies. Okay, most companies, financial statement, you don't find this R&D. Okay, is usually can be found in those tech companies, medical companies, or product owner that they have to keep doing research and development to keep their product ahead of the market. Okay, so this segment is not very common, so don't worry about that. Okay, what is very common is these two segments: your sales and marketing and your general and administrative. Okay, so let me talk about your sales and marketing first. So your sales and marketing, right, is actually marketing expenses. Okay, so if the company want to spend money on branding or marketing to get people to know about their products, right, they are usually recorded under the sales and marketing. Okay, and the general expenses, right, this part is where expenses that is spent to maintain their daily business operation. So like your employee salary, right? Employee salary is found in this segment. Okay. So when you combine these two together, right, you will always hear people say this word called SGA, selling and general and administrative expenses. So if you keep hearing SGA expenses, it means these two things add up together. So that is the SGA expenses. Next is, let's move on to the next expenses that they have, which is the European Commission fine. Okay, so this is not very common. This is only happens in Alphabet, which is Google, because there's a lot of data breach comes to this tech company. So in the end, these expenses become very normal for them. So they add it into their expenses space. So just ignore, you won't find it in any other company. Myron asked about how about entertainment to client. Yeah, entertainment to client will most likely come out inside general and administrative expenses. Okay. So just now when I say SGA is selling and general and administrative expenses, I just repeat because some of you asking this question, it's basically the combine of all these two expenses segment. It's called SGA, selling or sales, general, administrative, SGA. Okay, so let's move on. So when all these expenses add up, right, together, right, this is what we call your total expense. Okay, so in short, we call it total expenses, or sometimes people call it operating expenses. That means expenses to operate the business. And sometimes in investor term, right, you may hear this term called OPEX. Okay, OPEX is the short form of operating expenses. So don't get confused. It's exactly the same thing. Jeremy asked, how about travel expense? Travel expense is also inside the general and administrative expenses. Okay, so after you take the revenue minus off the total expense, you'll get this thing called income from operation. Okay, so there's a few words for this segment. This sometimes people call it the operating profit, or sometimes people call it EBIT. So you keep hearing the word EBIT, right? It actually means this income for operation, operating profit. So EBIT means earning before interest and tax. Okay, so you can see that the interest and tax is below. So it's earning before interest and tax. So that's what you call operating profit, EBIT, income for operation. It's the same thing exactly. Okay. Okay, let's move on. So sometimes the business, they have what we call other income. So your other income is what we call money earned from non-core business. So whatever the companies that record the revenue, right, in the revenue, that is based on the core business. So sometimes the company can make money from things that are not related to your core business, like they put the money in the bank, then they earn some interest. That will be under other income. Okay. HL asks, where's the depreciation? Depreciation is also found inside the general administrative expenses. It's just that you must go to the footnote to take a look. Then they will break it down into depreciation. Okay, so but as a whole, they will just summarize it as general and administrative expenses. Okay, if not, you can just find your depreciation here. Okay. Okay, so let's move on to the income statement. Oh, sorry, the tax. So tax is like your personal tax. You have to pay tax to the government. So you have on your personal level. So on the company, they do also have to pay tax. So next is what we call net income. So net income, right? There's many ways to call it. Some people call it net income. Some people call it bottom line. Some people call it earnings. Some people call it net profit or net income. Is totally the same thing. Okay, so don't get confused when you see or hear investor saying different terms. They are the same thing. Your net income, your bottom line, your earnings, and your net profit is exactly the same thing. Okay. So when it comes to earnings, the same thing that we want to see in revenue, we want to see increasing earnings, or we want to see stable earnings. Okay, so that's the two things that we want to look at. But what we want to avoid is decreasing earnings and volatile earnings. Okay, so that is those type of companies that we want to avoid. Okay, so let us look at the earnings of Alphabet. So you can see over here is increasing from 12.7 billion to 30.7 billion to 34.3 billion. So it's an increasing net profit. But of course, I'm saying that we have to look at least 5 to 10 years track record. We don't just look at 3 years. So in this case, I'm just showing you an example based on 3 years. At the end of this webinar, I will summarize the whole Alphabet in 10 years format to let you take a look. Okay. Okay, so when we want to look at the financial statement, right, we want to look for sudden surprise or sudden increase or sudden decrease in the numbers. We want to understand what is the reason. Is it a one-off case or is it a permanent case that's affecting the financial statement? So if you look in terms of the Google case, right, you can see that there's a sudden jump in terms of profits over here. Okay, and the net profits slow down over here, but there's a sudden big jump over here. Okay, so what causes the jump? We need to go and look at the financial statement. So if you look carefully under the tax part, right, you realize that in 2017, right, they pay a lot of tax, 14.5 billion. Whereas the last few years, right, they are just paying less than 5 billion of tax. So you as an investor, you have to always look at irregularity or surprise number jump. What is the reason for this 14.5 billion? Okay, so if you read the annual report, you will realize that in 2017, right, Donald Trump actually taxed those companies, right, who have operation outside of US, right, very heavily. Okay, so Alphabet, which is Google, they have operation around the world, not in US. So that's why the taxation for 2017 was a one-off taxation that affects their earnings. But you know that it's a temporary thing. So you know that actually this 12.7 billion net profit is actually much higher. So you know it's a one-off. So that you have to take note. Okay. So that as a whole is your income statement. Okay, every line that I explained to you. So right now, let's move back to what we call the matrix. So inside the income statement, right, these are some of the metrics that I always look at. Okay, first is what we call gross profit margin. Okay, so the gross profit margin, right, measures the percentage of the company's revenue after deducting the cost of goods sold. Which just now you already calculate the gross profit. So later we're going to take the gross profit divided by the revenue. So that is the formula for gross profits. Next ratio that I always look at is the net profit margin, which is your net profits over your total revenue. Okay, it is actually the amount of profit a company keep for every dollar of revenue. So the higher the margin, the more profitable a company is for every dollar it is to make in their revenue. Okay, so this is the formula: net profit over the revenue. Okay, so let's move back to the financial statement. So if you look at the financial statement, just now you calculate that the cost, the gross profit is 90 billion. Okay, and the revenue of the company is about 161.9 billion. 161.9 billion. Okay, so right now take out your calculator and calculate how much is the gross profit margin for Google, for Alphabet. Okay. Okay, so I think most of you get it right, is 55.6%. Okay, when you do investing, just do it to one decimal place always. Okay, so the gross profit for Google is 55.6%. Okay, so when we look at gross profit margins, right, there's a few things that we want to look at. Okay, let me just clear off this. Okay, so when we want to look for companies that have increasing gross profit margin or stable gross profit margin, or sometimes the gross profit margins can decrease a bit. It's still okay, but we do not want them to decrease a lot. So slow decrease in GP gross profit margin is okay. Okay, so just take note about it. These are usually the three types of gross profit margins that I'm looking at. Okay, so this is what you want to avoid. First, decreasing fast gross profit margin. So this totally avoid. So if you see the company's gross profit margin, right, decrease a lot, totally avoid it. Or volatile gross profit margin. That means the fluctuation between the gross profit margin is 30-40% difference. Okay, that is totally way off. And that means this type of business are usually very cyclical type of business. Okay, so these are the two types of gross profit margins that you want to look at. Okay, so why do we look at gross profit margin? Is we want to look for companies with gross profit margin of at least 20%. Okay, I always like the 80-20 rules. So 20% will be a good figure. Okay, Zhe Hong asks, why is slow GPN okay? Okay, I mean, sometimes as the business keep growing, right, it's very hard to continue to stay competitive. So sometimes the business has to lower a bit of their gross profit margins to fight the competitor. So we cannot penalize such companies, but they will save. They will cover up the decrease in gross profit margin with the cutting off their operating expenses to maintain the net profit margin. So you cannot totally cut off the business if the gross profit margin is decreasing, but it's decreasing slowly. It's okay, totally okay. Okay. So we want to look at least 20% of gross profit margin. Why do I look at that? Is because gross profit margin, right? If the company's gross profit margin is high, right, it gives the company room to cut. Okay, so it also gives the company choices if they have very high gross profit margin. But if the company have very low gross profit margin, let's say 10% gross profit margin, then when it comes to cutting off from the operating expense, they do not have much room to cut. Eventually, they will end off with very low net profit margin. Okay, so usually companies with high gross profit margin, right, have advantages over companies with low gross profit margin. So do take note about that. Okay, so let's move on. Next we want to look at the net profit. So if you look at the net profit of Google, is about 34.3 billion. So the revenue is about 161.9 billion. Okay, so right now I want you to calculate what is the net profit margin of Google. Okay, cool. I think most of you get it right. Okay, so always round it up to one decimal place. So it's about 21.2%. So that is the net profit margin that we look at. Okay, so just do take note that net profit margin, there's no fixed percentage like gross profit margin. Okay, doesn't mean that the company have low gross profit margin is bad, or is the company have high gross profit margin is good. Okay, there's no fixed percentage to gross profit margins. So do take note about that. Okay. So of course, in general, the higher the margin is better. But like I said, it doesn't mean low gross profit margin is bad. If you look at companies like Walmart, net profit margin, I'm saying, not gross profit margin, or Costco in the US, right? Walmart's net profit margin is about 2.8%. Costco net profit margin is about 2.4%. So they have very, very low net profit margin. It's okay to have low net profit margin. Okay. CC asked what's the ideal ratio for net profit margin. Like I mentioned earlier, there's no ideal for net profit margin. It depends on the business. So for in this case, if you look at Walmart and Costco, they have very, very low net profit margins, 2.8%, 2.4%. But doesn't mean that they are bad. Okay, these two companies have been doing very well for the past 10, 20 years. Okay, if you want to have low net profit margin, right, you must have scale. Okay, so that means able to scale up. So like for instance, if you look at Walmart and Costco, right, even though their gross profit margin is very low, but they got very big scale in the US market. So that's the most important thing. If you want to buy companies with low gross profit margin, they need to have scale. But if they are low gross profit margin, low net profit margin, but they do not have scale, then this company we must avoid. Okay, just remember that low gross profit margin must have scale. Then it's a good company. Okay, so these are generally the two ratios that we look at. Okay, so next thing I want to mention is that a lot of investors, right, they tend to want to look at the operating expense of the company. So for in this case, right, they usually will take the total operating expense divided by the revenue, and they will come out with this formula called OPEX over sales. Okay, so the higher if the company keep getting higher OPEX over sales, which means that their cost is creeping up. Okay, so the next thing I want to say is that, right, I don't really look at OPEX over sales. Why? Because the net profit margins and the gross profit margins can tell the difference. So let me explain here. So if a company have a gross profit margin maintaining, okay, a company maintain the gross profit margin, but if the company, right, net profit margin is decreasing, without calculating the operating expense over the sales, right, by looking at the gross profit margin and the net profit margin, right, it can shows you the difference of this thing, right, is because of increasing of costs, increasing of OPEX expenses. Okay, so this one tells you that. So you no need to double calculate and use OPEX over sales ratio. You basically look at the gross profit margin and the net profit margin. You can tell whether the company is maintaining the expense or not maintaining the expense. So by looking at these two, it can tell you everything. So in this case that I'm showing here, it means that the company is not managing, right, their cost well. So usually in this case, right, I would say it's a red flag. Okay, this is a red flag. Okay, so that means this company is going to go into some issue. So this is one thing that I look at. Okay. Okay, so let me go back to the, sorry. Okay, let me just go back to the screen. Okay, so next is we want to talk about the balance sheet. So I hope you guys have a clear understanding of what the whole income statement is all about. Okay, I think some question asked about how do we know the company got scale as different from the industry. I think Jane asked, is it? Okay, so scale is what we call the addressable market or the customer they serve. So in terms of the Costco and the Walmart case, right, they have very big scale is because the whole US have about 300 over million population. But if you talk about, let's say, companies just in Singapore population is about 5.6 million. Sorry. So there's literally no scale in Singapore. So most Singapore companies do not have scale unless they are outside of Singapore. Okay, so that's the meaning of scale. Okay, so now let's move on to talk about the balance sheet. So this is how the balance sheet looks like. So inside the balance sheet, you look at three different things. The first thing is what we call assets. Okay, assets is like on your personal level, right? It's like your house, your cash, your investment, your cars. They are all classified as asset inside the balance sheet on your personal level. And your liability is the debt that you owe to the bank. So if you borrow money to buy a car, you borrow money to buy a house, your loan, your debt will be placed under liability. And when we talk about equity, equity is when you take the total asset minus the total liability, and this is what your net worth is. So for instance, if today you were to stop working, you got no income. So you take all your asset, you minus off your liability, right? Whatever left behind, that is your net worth. So your equity is equals to the net worth. So for the company case, the equity is the net worth of the company if they liquidated everything. Okay, so there's still a very slight difference in terms of the company balance sheet and your own personal balance sheet, because the company balance sheets, they got other items that you do not have, which I'm going to explain it later. So to summarize it, asset is stuff that you own, liability is things that are other people's money that you use, that you owe people, and equity is your money after you paying off what you owe. Okay, so this is how the balance sheet looks like for Google. So if you look over here, the assets is the assets that we talk about. The liability is over here. Then you have the equity over here, this part. Okay, so this is the whole balance sheets that you look at. Okay, so there's a lot of figures in the balance sheet, but what I'm going to say is that I'm going to focus on those numbers that I usually focus on. Okay, so if you look at the balance sheet, right, you realize this thing called current asset and non-current asset. So you can see over here. Okay, so this part is your non-current asset. This part over here is your current asset. Then this part over here is your current liability. And this part here is your non-current liability. Okay, what do you mean? What do you mean by current and non-current? Is that when they say it's current, right, it's usually less than 1 year. The debts that the cash that you hold less than 1 year, or the debt that you need to pay less than 1 year. So when they say non-current, right, it's usually more than 1 year. So that is the two things that you want to look about. Okay. Oh, I think Alvin's talk about putting it on landscape. Let me try. Okay. Yeah, I think this will be much better. Is it much better? I think this will be much better in landscape. Okay. Thanks for your suggestion, Alvin. Okay, so let's move on. Okay, so for the current asset, usually when I want to look for is I want to look at a few things. There's only a few things you look for in the the current assets. Okay, first one you look for is the cash equivalent and the marketable securities. Okay, which is this part. So they already total up the figure over here for you. So this means the cash or the cash and cash equivalent or the marketable security that can be liquidated within 1 year to convert it to cash. Okay, so every time when investors says about cash in the company, is this segment. Okay, so this is what we want to look for. And the next thing is that after I look for cash, right, the next one is I want to look for debt. I want to compare whether the company have more cash or more debt. So if I scroll down, when I look at debt, right, I want to look at the current liability and the non-current liability and look out for this term called loan, debt. So these are the few words that I want to look out for. Okay, so if you look at the company's debt, right, on the current side, there is no debt. So totally no debt. But on the non-current side, there's long-term debt over here. So which is these two figure. Okay, so if you look in Alphabet case, right, let's say in 2019, they got about 119.8 billion, 119.8 billion in cash. And they got debt of 4.554, okay, 4.6 billion. I'll round it up. 4.6 billion. Okay. So in this case, right, I noticed that this company, right, if any issue happens, like the recent coronavirus case or any financial impact, right, this company won't go bankrupt because they have more cash than their debt. They can definitely survive through any economic crisis because they just have about 4.6 billion in debt, whereas they got 100 over billion in cash. So this is the first thing that I look out for. The next thing I want to look out for is the few things that I look out is the account receivables. So account receivables are what we call things that your customer owes you. Okay, so in a real business term, right, every time when you do business, right, you don't immediately get cash out of the your customer. Usually your customers, right, will you'll give your customer 30 days credit term. So you'll provide the service or the product to your customer first. After 30 days, your customer will give back the money back to you, what they own. So these are usually your account receivables. Next is what we call your inventory or inventory. Depends on how you pronounce it. Okay, so this is your stocks. Sometimes you can see the word stocks is the same thing. Okay, so these are products. If you are a product-based company, these are the products you sell. Okay, so for Google, they do not have much product, so you can look at their inventory is actually a very small amount. Okay, but if you look at all those product-based type of companies like Starbucks, or Ulta, or Under Armour, their inventory tend to be much higher. Okay, so these are the three things that I usually look at in the current assets. Okay, sometimes if you want to understand a few more things is that you can look at what we call this one property and equipment. So these are usually their fixed assets. So sometimes you'll see terms like fixed asset, or you will hear terms like PPE. So it means their property, plant and equipment. So these are all the assets that they buy to run their businesses. Okay, then you have what we call intangible assets and goodwill. So these are non-cash based. Okay, so for instance, like your brand, the brand of Starbucks, they also worth some value. As much as it is intangible, you cannot touch it, but the brand itself worth something. Okay, so that will be under the intangible assets. Goodwill, most of the time, is what we call when a company acquire, let's say the company's book value is that I want to acquire, the book value is 100 million, but I purchase the company at 200 million. So there will be an excess of 100 million. So the excess of 100 million will record as goodwill inside the asset. Okay, so that's how you look at for goodwill. Okay. So let's move on to the debt, the liability. So in the liability part, not much of things to look at. Usually I look at the debt, which I already told you that, which is very, very important, because you want to make sure you don't want to buy into a very debt-ridden companies. So you don't want to bankrupt your companies, okay? So for the current liabilities, right, we always look at this, what I call account payables. So for instance, like I said just now, when you sell your products, your Apple to your customer, right, it will take you a few days, a few months, or 1 month to get back from the customer, the money that you own. Okay, but account payable is the just part where you bought the seed, you bought the fertilizer from your customer, right? From your supplier. You take some time to pay them back. You pay them back in a 30 days credit term. So that is what we call your account payable. So these are some of the places some of the things that I look at. Okay, that's all for the liability. That's the only two things that I look at. The rest I don't think is much important, because most of the companies, right, if you look at the current liabilities or the non-current liabilities, it usually make up of the account payables and the debt. That's all. So that's the two things that I look at. Okay, so let me go back to the slide, and I'm going to talk about some of the ratios that I look at personally. Okay, so in the balance sheet, right, there's certain ratios that you need to look at. Okay, so there's two ratios that I look at. The first one is what I call return on equity. So return on equities measure how much profits is generated for every dollar of the shareholder equity. So usually for this, right, the higher the return equity, right, usually the better the company is at generating returns for the shareholder. So generally, you want to look for companies that have return equity of more than 15%. They are usually the fast asset-light type of companies. Okay, but doesn't mean 10% return equity is bad. Some companies, they also have 10 or 12% return equity. They still perform well, but generally the better companies, they usually have more than 15% return on equity. So when we look at return equity, is that every time when companies, right, can consistently maintain the return equity, right, over a long period, let's say 15% return equity, right, over a long period of time, right, the share price will compound about the same way as the return on equity that they have. So how do you calculate the return on equity? Is you take the net profit of the company, okay, you divide it by the shareholder equity, okay, which is over here, your net profit over the shareholder equity. The next ratio that we want to look at is this thing called debt to equity. Okay, so debt to equity measures the debt level of the financial leverage of the company. So it reflects the proportion of the debt, the equity used to finance the company asset. Okay, so this is the ratio, which is total debt over the total equity of the company. Okay, so when do we use this is when, if you look at Google case, right, their debt to equity, I don't need to look at their debt to equity. Why? Because they have more cash than debt. So I know there's very high chance they will survive any adversity. But if a company have more debt than cash, I usually want to look at their debt to equity. So that's how I always usually do the gauge. Okay, so if you can see the company have more cash than debt, right, you no need to calculate the debt to equity. But if the company got more debt than cash, then you want to calculate the debt to equity. So every time when you look at the debt to equity, right, you want to look for companies that have debt to equity of at least 0. I have a gauge 0.8 and below. Okay, the stronger companies have 0.5 time debt to equity. So that means the debt is only 50% of the equity. Okay, so let's move on to look at the balance sheet on where can you get the figures. Give me a minute. So if you look at the debt to equity, right, the ROE, right, you take the net profit, which was over here. your 34.33 billion, you divided by the equity. So equity, you can get it from here. You can get it from here. Your total equity, can you see that? So that's your figure. So you take the net profit divided by this figure. So that's your total equity. So now you got your total equity. You also can calculate your debt to equity, which is your long-term debt. There's only long-term debt for Google. So you can take this amount divided by this amount. That's your debt to equity, which is a very small figure for Google. Okay. So let me move back to the slides. Okay, so if you look at the cash flow statement, I'm just going to explain using this cash flow statement over here, so that I'm running on a low battery now, so I'm sorry about that. Okay, so if you look at the cash flow statement, this is how it looks like. And why do we look at cash flow statement? Let me explain a bit more about why we use the cash flow statement. Okay, so if you look at a cash flow statement, right, it's something that is, you cannot do it on a personal level. Okay, because it's only on a corporate, on a company level that you can see a cash flow statement. On your personal side, you don't really see a cash flow statement. Okay. So let me explain a bit why we look at cash flow statement. So let's say I'm an Apple supplier. Okay, I sell my Apple to a grocery store, and the grocery store sell it to the customer. I give the grocery store a 30 days credit term. So they take them 30 days to pay me back my money. So that is what we call the receivable, which I talked to you in earlier on in the when I talked to you earlier on in the under the balance sheet. Okay. So why do we look at cash flow statement is because if you remember correctly, right, during the income statement, I talk about the revenue. They record the revenue every time when a transaction have occurred. So they either provide a product or they provide a service. Okay, but then on the actual term in a business world, right, they don't actually get the real cash coming in because they give them a 30 days credit term. So that is not your actual cash flowing. So that's the reason sometimes you can hear investors saying that, oh, profits is just paper gain. They are not actual cash. So a company can record, very, very high profits, but if they are unable to collect the money back from the customer, it will become a bad debt. And it's also usually a bad sign for the companies. That means they didn't manage their cash flow properly. So when you look at the cash flow statement, right, you need to understand, right, how the cash flow, right, is flowing in and out of the business. Okay, so let me go back to the slide of the cash flow. So I'm just going to use this screen to talk to you. So if you look at cash flow, you can see this part here over here. You see my mouse, I'm circling over here. This is what we call your operating activity. So inside your cash flow statement, right, there's three things that you look at: your operating activity, your investing activity, and your financing activity. Okay, so your operating activity, right, is the cash in and out flowing based on your operating business. That means your daily core operating business. Then your investing activity over here, right, is the amount of money that you actually you spend the money to buy into CapEx, your capital expenditure, to maintain the business. So you can see all the figures in here that involve in investing, or you invest in any assets, right? You will be inside this investing activity part over here. So if you can see on your cash flow statement, you got the no brackets and you got the brackets. The no brackets is actually cash inflow to the company. The one with the bracket, right, is the cash outflow of the company. So if you look at financing activity, right, this part is where the companies get finances. So if, let's say, the company were to borrow money from the bank, right? In this case, if you look at Google, there's this thing called repayment of debt over here. So repayment of debt, you can see is negative because they are paying off their debt. So that is negative, which is outflow of money. Where this one is, you see, proceed from issuance of debt. So they borrow money, so there's an inflow of money inside the company. So if the company raise money from the stock market, they also will come out inside the cash flow statement. So these are the things that we want to look at in the cash flow statement. Okay, so let me log on to my iPad and I can show you more in detail. So I'm just going to summarize here to save some battery. So basically, there's only two things that you want to look at in the operating cash flow statement. Okay, the first thing you'll look at is the actual cash flow. The actual cash flow of the company. So which is here. It's always the same. It's a universal figure. Okay. So that's the cash flow. Every time I hear people say cash flow is this thing. Okay. Net cash provided by operating activity. Oops, give me a minute. So the next thing that you want to look at in cash flow statement is what we call the CapEx, which you can see over here. Okay, when you say CapEx, it's usually purchase of property, plant, and equipment. So this is what we call CapEx. Okay, so your cash flow minus your CapEx, it will give you what we call the free cash flow. So this is the things that you want to look at, your free cash flow. Okay, so just do take note that sometimes for your CapEx, right? Give me a minute. Let me just switch back to the slides. Back to the slides. Okay, so every time when we look at the CapEx, right, there's a few things which is your purchase of property, plant, equipment over here, right? So when we talk about CapEx, there's a few terms that we talk about. One we call the development CapEx. Another one we call the maintenance CapEx. Okay, so most of the time, right, companies, right, every year have to spend money on the maintenance CapEx to keep the business going. Okay, maintenance CapEx have to spend on. You cannot escape without spending maintenance CapEx because you need that to keep the operation going. Okay, but certain years, right, the company do have development CapEx. So development CapEx is CapEx they spend that will bring in future revenue. So let me give you an analogy. So if you own a restaurant, a F&B company, okay, and you spend money on refurbishing the stores, your existing stores, right, that is your maintenance CapEx because you don't bring in additional revenue. But if you spend money opening up new stores, that is what we call development CapEx, and that's bringing new revenues to the company. Okay, so when you look at free cash flow, right, you have to look at whether that year the CapEx majority is development CapEx or maintenance CapEx. Okay, so for instance, suddenly the CapEx jump up very high figure, and you compare to the previous year is a much smaller figure. Then you have to go and read whether the company is spending on building new factories or building new stores. If they are doing that, right, it's okay, even though your free cash flow is negative, because you know that they are spending on development CapEx, they will bring in future revenue. Okay, to see whether they are spending the CapEx are doing right, you have to track the next few years whether the cash flow is increasing. If they keep spending on development CapEx and the cash flow is keep decreasing, right, that means their expansion failed. So that is how you should look at in terms of the cash flow. Okay. So some of the metrics that I really want to look at is actually what we call cash flow to net income. So basically, just now I already told you where do you get your cash flow, which is your net operating cash flow. You take that divided by your net income, which is your earnings, which I already told you where to get it, Eddie. Okay, so the cash flow to net income, right, is used to measure the quality of the company's earnings. So sometimes you can hear people saying this short form called QOI, quality of income. Cash flow to income is exactly the same thing. Okay, you want to see the quality, because I can tell you that sometimes net profit is paper gain. So you want to find companies that have the cash flow to net income like consistently above 1. That means their net profits, their net income quality is very high. That means they can take back their cash easily. Okay, so if companies that have consistently below, let's say 0.8 time, right, cash flow to net income, right, usually they have problem, collecting their money back from their customer. That means the customer have bargaining power over them. But if a company can consistently get cash flow to net profits, cash flow to net income more than 1 time, usually they have much stronger bargaining power over their customer, or their business can be financed by their supplier. That means they have strong bargaining power over their supplier. So it's either way round. Okay, so just do take note about that. Okay, so this is the formula, your operating cash flow over the net profit. Okay, so to summarize everything, what I've taught you, the numbers, the financial numbers that you look at, the matrix that you want to look at for the company, right? I summarized everything using Alphabet, using their 10 years financial statement right here. Okay, so if you look at Alphabet, the first thing I want to look at is growing revenue. So can you see that Alphabet's revenue is growing from 29.3 billion to 161.9 billion. So does this company pass our first criteria, increasing revenue? Okay, thank you, Fook Hai. I think most of you knows that Alphabet definitely passed the first criteria. The second criteria is we want to look for net profit increase. So if you look at Alphabet, right, their net profit has been increasing. Okay, but there's a dip in 2017. So if you remember earlier on when I talked about 2017, I said that because there was a one-off tax. So that was a one-off case. So if you were to adjust back, right, actually 2017, right, is actually higher than 2016. But because it's a one-off case. So we know, but I didn't adjust it because I know that was a one-off case. So actually, if you talk in terms of net profit, right, they are consistently increased from 2010 to 2019. So they pass our second criteria. And next is you want to look at their gross profit margins and their gross profit and net profit margins. So if you look at Alphabet, right, their net profit margins has been slightly reduced to maintain the competitive advantage of the company. But if you look at their net profit margin, right, they have been maintaining between the 21-22% range. So it's rather maintaining very, very well. So they passed the third criteria. Okay, just take note that 2017 was a one-off case. So if you adjust back, it's actually 21-22%, same as the rest. Okay. Then we look at the return equity of Alphabet. So we want to look for companies that have consistently above 15% return on equity. So do you think Google passed the criteria? So thank you, Raymond. I think most of you knows that they actually passed the criteria. Just do take note that 2017, like I said, it was a one-off case. 2014, 2015, it was just 1% below 15%. So sometimes you can close the eye. No need to be exact 15%, but as most of the time above 15% is okay. Okay. Once in a while they drop to 14%, you can still close one eyes. 2017 was actually much higher than 14%. So if you adjust back, so most of the time they're above 15%. So actually they actually pass the criteria. I would say that. Okay. You have to be a bit flexible in investing. You cannot be too fixated on the numbers. The numbers is a guideline to you. Okay, but you can bend a bit. 1-2% is still okay. 1-2% off. Okay. So then next is we want to look at the cash. Like I said, I go to balance sheet. The first thing I'll look at is the cash versus the debt. So if you look at Google, this is the cash and investments that they own. And this is the debt. So you can see that they got more cash than debt. And they can easily buffer for bad times. Okay, but of course I say if the company got more cash and debt, you don't need to calculate the debt to equity. But for this exercise, right, I just want to calculate the debt to equity and let you take a look. So if you look at the debt to equity of Google, it's actually only Alphabet, it's only 2%. So it's a very small, and it's a decreasing trend. So it's a very, very favorable situation that they are in. Okay, so the next thing is you want to look at their quality of income, or what we call the cash flow to net income, whether they got high quality earnings. So if you look at cash flow to net income for 2010 to 2019, they have been consistently above 1 time. So Chiwi asked actually, can ROE as a ratio be manipulated easy? Yes, it can be manipulated easy. if the earnings, right, the net profits are being inflated. That's why we want to look at the cash flow to net income. So if the quality of income, which is the cash flow net income, is high, then the ROE will not be easily manipulated. So do take note about that. Okay, so if you look at Alphabet, right, they have very good all the track records that I show you, the revenue increase, the net profit increase, they pass all the metrics that I show you. So now let us look at the share price of Alphabet for the past 10 years on how they have performed with all these good metrics that they actually happens to them. So if you look at the share price of Alphabet, right, from 2010 to the latest share price when the COVID-19 hit them, you can see that their share price have outperformed, have consistently gone up from 200 plus all the way to 1000 plus. So for the past 10 years, they went up about 5 times in returns. So it reflects in those numbers and matrix that I showed you. So this is how you should look at financial statement when you analyze the company. If you were to do those numbers that I teach you how to read financial statements, right, you can easily analyze a company in just 10 minutes looking at the financial statement. But do take note that financial statement is only 1/3 of the investing. There's of course the other 2/3 of the investing that tells about the company. The first 1/3 is actually the business of the company. The second 1/3 is the management of the company. And the last 1/3 is your financial statement. And I hope you like this segment, this webinar that we have done for you. And I hope after this, you really know how to read financial statement, analyze them using the financial ratio. So thank you for attending this webinar. I'm blown, by the amount of questions that you guys give me and how many people have actually attended this webinar. So thank you so much, and do stay safe during this time of COVID-19. And do watch out for email, because I think we'll do more webinar because we can't go out of our house. So do stay safe, wash your hands frequently, and I will see you in the next webinar. Thank you so much.